So I was chuckling to myself when you talked about this as a roller coaster. The analogy I would use is a bungee jump,
Yep.
because it has that vertical drop and that intense reversal. The cord caught and then pulled. It feels like it's almost pulled the market back up. And that to me is important. It says to me that behind the scenes of a market that is, at or near all-time highs, there's a level of anxiety that shows up in incredibly impulsive and emotional behavior. This is a crowd that doesn't stick around. It moves and asks questions later.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's expert, behavioral economist Peter Atwater, adjunct professor at William and Mary College, has long affirmed that changes in confidence consistently and predictably impact investor preferences, decisions, and actions. Well, there's certainly been a lot happening so far this year to both spike and crash investor confidence. It's been one heck of a sentiment roller coaster so far, with little signs that things will calm down anytime soon. So, what are likely to be the biggest drivers of confidence from here, and what are his key indicators telling him about the prospects for the rest of 2025? Well, we'll ask the man himself. Peter, thank you so much for joining us today.
Great to be here, Adam. Thank you.
Thank you. Well, Peter, I should start with an apology that it has been far too long since your last appearance on this channel, so I'm glad we're rectifying that now. I'd also like just to acknowledge, I think, a really nice bit of praise that you got recently. I was interviewing Jesse Felder, who both a friend, friend of both of ours, but also just one of the more thoughtful, smarter people I have the pleasure of interviewing, and he really took his time to pause and call out your work as one of the top influences on him. And I thought that was, I think a well-deserved, well-earned honor, but a good honor as well.
Yeah, it was very humbling. I'm a huge fan of Jesse and his work, and to hear him talk about the confidence map and how that's been helpful to him, um, yeah, that's tremendous praise, and
Well,
just very humbling.
and just to be clear too, I hear praise from you, not just from Jesse, but from other folks I interview as well. In fact, I just got finished interviewing Stephanie Pomboy a few hours ago and mentioned to her that I was going to be talking with you, and she said, "Please give Peter my best," and again reiterated what a big influence you've been on her.
And a huge fan of Steph's as well.
All right, well,
Very
it's
fun.
a mutual appreciation
Uh,
society here at Thoughtful Money. All right, well, look, let's dive right in, and I guess, let's just start from a high level. Um, On a score of 1 to 10 for volatility, how does 2025 score so far, confidence-wise?
so I was chuckling to myself when you talked about this as a roller coaster. The analogy I would use is a bungee jump,
Yep.
because it has that vertical drop and that intense reversal. The cord caught and then pulled. It feels like it's almost pulled the market back up. And that to me is important. It says to me that behind the scenes of a market that is, at or near all-time highs, there's a level of anxiety that shows up in incredibly impulsive and emotional behavior. This is a crowd that doesn't stick around. It moves and asks questions later.
Yeah, and this is sort of one of the things I was talking about with Stephanie earlier. The market really does sort of seem to have kind of this bipolar nature. There doesn't seem to be much sort of in the middle. There doesn't seem to be much of a Goldilocks from a sentiment standpoint. It is either things are going to hell in a handbasket right now, or the future's so bright I got to wear shades. Does that tell us something? I mean, does history sort of tell us when you get to a market that is that sort of schizophrenic? Does that say where we are anywhere on the story?
Yeah, I think of this not as risk off, risk on, but risk in and risk out.
Hmm.
So to your point, there's no middle. It's all in, all gas pedal, or all brake. And that says to me a couple of things. One, it brings back market memories of the 1960s, where you had markets that moved like a yo-yo, but really didn't go anywhere. So again, volatile people creating volatile times, volatile markets. But it also speaks to me about sort of this passenger seat environment with investors. One of the things that I notice a lot is that this is a group of people that have become very complacent in the passenger seat, whether that was with allowing the Fed to drive, or fiscal policymakers to drive, or even post the election, allowing President Trump to drive. And the passenger seat, which I write about in my book, is an environment where we have certainty but no control. And you can think about it like an airplane. Everything feels great until we're all praying because we're afraid the plane is going to crash.
Mm-hmm.
And I think that it's that backdrop of not uncertainty that gets all the attention, but the inherent powerlessness that investors feel today, that CEOs that I talk to feel today, and that feeling that I'm either going to be a incredible beneficiary or a absolutely obliterated victim of decision making of others.
So you said several things here that I think is really interesting. So to the extent that what we're seeing now is similar to the 1960s, lots of volatility, but at the end of the day, you don't really go anywhere. Um, we've had a lot of people on this channel recently who have made sort of similar assessments about 2025 at least, and perhaps maybe even a longer stretch than that ahead. But of course, their message is the passive investing strategy worked really well over the past decade plus. That's probably not going to work nearly as well in that type of environment, and therefore you want to adopt more of an active investing strategy, which a lot of these people are sort of positioning as a return to the way that investing used to be, where you had to do your homework, you had to try to identify the good companies, separate the wheat from the chaff, and try to invest in those companies. Where everybody's been so conditioned now to just buy the general market or buy the index and just hold, buy the dips, and know that the Fed, uh, fiscal spending, the new president have your back, right? And when you talked about this sort of passenger seat mentality of investors and CEOs and whatnot, it's not a huge surprise after so much time of artificial intervention in the markets that you learn to stop fighting it, and you just learn to go with the flow, right? That not a huge surprise. So in many ways, this is somewhat a self-inflicted situation we find ourselves in, and it's maybe a poor analogy, but I recall hearing a comment from a Russia expert where somebody was talking to them about, post-fall of the Berlin Wall, would Russia eventually, adopt capitalism once it got a real taste of it? And their saying was, well, if you understand Russian history, the Russian people just kind of always want a czar. There's just something in their culture where they just kind of expect that there's going to be some strong man to tell them what to do, whether it's a czar or whether it's a modern version like a Putin, right? And I wonder if we've created this environment for so long in the markets that the average Western investor is just looking for somebody to drive the bus, as long as the bus goes up over time more than it goes down.
Yeah, and I see this particularly in the post 9/11 generation. If we think about what happened in the world of parenting post 9/11, it became about keeping kids safe. And so anything that was viewed to be uncertain became perceived as unsafe. And so you had lots of parent involvement. We talk about tiger moms and helicopter and
Yep.
bulldozing parents. But this is a generation that has been led to, they have been happy followers. Somebody else has fought the battles for them. And I think that that transcends so much American behavior right now.
Mhm.
That this is a group that would happily, stew in the passenger seat rather than get in the launch pad. The idea that they would take control is anathema to many of them. They don't know how, they have no experience leading. You, I suspect, like me, we're raised as kids, I was told go outside and play and don't come back till dinner.
Yeah, the era of really kind of benign parental neglect. Yeah.
Yeah, but with that, we learned how to manage, take control in uncertainty. And yes, the outcomes weren't always wonderful, but we learned from them. We developed scars and bruised. We learned about courage and responsibility and lots of important things that in for many people today have been postponed into their lives.
So let me dig into that for a second. I think that's really important. So you're the behavioral economist. I'm not. So this is my armchair version. Please correct what elements of it might be wrong. Um, but raising this post 9/11 generation the way that you described, we've taught them that safety matters most, and we've taught them that they should seek safe spaces, and set the expectation that they should expect to have a safe space, right? Which really doesn't map to real reality, right? And so, using this from an investor mindset, um, yeah, you want to have an environment where the markets are just steadily going up over time because of intervention, right? And that's what you expect. When the worm turns market-wise, these people are sort of the least prepared to deal with the shift in markets. So in other words, you're potentially setting up this younger generation of investors for extreme disappointment if their expectations are set on being taken care of by kind of the market gods and expecting to have safety where, you know, in a volatile world, the safety is not a guarantee.
No, and discomfort is the norm. One thing that really bothers me is that this sense of any discomfort is being translated as a lack of safety. That we're going to have an uncomfortable conversation. I'm going to raise a viewpoint that's counter to yours,
And then I'm
and
going to cancel you, Peter, just so you know.
and so my backlash is extreme as opposed to let's have this conversation, and respect each other and learn from each other as opposed to fleeing from that possibility. I mean, I think our echo chambers in terms of media consumption are a reflection of our
Yep.
unwillingness to introduce uncertainty into our lives.
So I want to get to what does it look like in a world where people conditioned to safety and certainty suddenly don't have it? What are the implications you expect from that? But real quick, if I can do just a quick tangent, because you're the perfect guy to clarify this with. Um, what I had heard was this actually started before 9/11. I think 9/11 was a real catalyst in kind of solidifying the supremacy of safety. But what I had heard was that there was a shift in the mid 90s, that if you ask people who were born, I think the year was before 1996, what's your first memory of being out in the world by yourself without your parents, literally exploring the world? Um, and the average, I think, was around 5 to 7 years old. Oh, I used to get to walk to my grandma's on my own, or I could walk to school on my own, or I could go out and play until the streetlights came on and then I had to come home type of deal, right? And if you ask people born after 1996, it's more like 12 to 15 years old. And what changed, at least initially, was they attribute it to the advent of 24/7 cable news. So there was news on all the time and airtime that had to be filled. And then it was the abduction of Polly Klaas and I think one or two other children that were abducted. And that was all over the airways in these new 24/7 news channels. And it put the fear in the mind of American parents, oh my gosh, that could happen to my kid. And so parents got a lot more clingy or hovering. And then, of course, 9/11 really amped up that stuff. And the societal impact of that was to your point, when you're a young kid and you're out in the world exploring it on your own, you deal with adversity, you learn how to overcome it, you're inventing and playing games with your friends, and you have disagreements and you learn how to work through them. So by the time you get to college, um, you know, you can know how to handle interpersonal disagreements, and it's just all part of life, and you're pretty facile with that. Whereas if you don't get started until your teens, you don't have enough time. So by the time you get to college, and I'm curious about the college part because you're a professor, by the time you get to college, you still don't know how to process that stuff well. And so when you have disagreements or adversity with others, you interpret it more as like you're reacting lower on your cerebral base, brainstem, and you're taking it more like an existential threat on you, and so you react like to a physical threat, and you want to cancel people, and you demand, I've got to be protected from this, right? So, A, is what I'm saying, is there any real grounding in that? And B, what are you observing living in the academic sphere?
Yeah, so two thoughts that came to mind. One is think about the minivan and what the minivan of the 1990s was intended to do. I mean, we were shuttling kids back and forth and around that, we needed these vehicles to move lots of kids at once to from one location to the next. So your point about protecting them is to me real, so you can see the cultural response.
Hmm.
At the other end, the college end, what fascinates me most, Adam, is that again, I feel like the man who was raised in black and white TV. But one of the things when I talk to my peers about the college experience is our parents dropped us off, and at best we might see them at fall break, maybe Thanksgiving. In my case, I didn't see my parents till Christmas because they were overseas. But you burned the ships. The ships were
Yeah.
burned. And that requirement to be there and to know that you had to make it work there is something that this generation doesn't have in their life. They know that they can move, they can transfer, they can call old friends, they can flee from their current space easier than any generation before them. They have mobility that was unavailable. And as a result, they never are forced to bloom where they're planted. And I think that has huge implications to community and service to others and being part of something that is intimate and physical in terms of your relationships. And that goes away because I don't have to make it work.
So super fascinating. So, okay, so if that's how the younger generations have been raised, and by younger generations, we're really talking millennials, Gen Z, Gen Alpha, et cetera, right? Um, with Gen X as maybe the transition generation, and the boomers being purely grew up in black and white TV, at least initially. Um, what does that lead you to expect for society? I mean, I'll bring it back to investing, but like,
Yeah.
what are the implications? I'm sure I can invent some negatives. Are there some positives? Is it more corrosive than it is beneficial? What are you looking at?
So I look at the volume of individuals who feel today trapped in the passenger seat, who realize that, or they're coming to realize that they have sacrificed control for certainty
Hmm.
and that they find that really unsatisfying.
Sorry to interrupt, but I mean, it harkens back to the old quote attributed to Benjamin Franklin, right? Those who would prioritize security over liberty deserve neither.
Yeah,
Yeah, they're waking up and realizing, hey, I've made a trade-off that actually isn't serving my long-term interest here.
right. And has left me ill-equipped to be an entrepreneur, to be an inventor, to be a true creator, because they have been raised to be passive. And I see this particularly frustrating to young men
Yep.
who feel this need to be in control. And on the one hand, we could say that this is bad, but on the other hand, I am looking forward to those moments where this next generation concludes it's time to take control.
Hmm.
And I'm excited to see what they do and the direction that they take things, and the sense of inherent community and responsibility that will come with that. This is a generation that has never had to demonstrate courage or sacrifice. They have been raised in an environment of abundance, not just of stuff, but of safety. And so they're going to have to confront scarcity and a need for priority and issues of sacrifice that I think will form the basis for what comes after this turmoil that we are within. I mean, I think there's a real generational transfer that is underway behind the scenes. You know, we have an old guard in both Republican and Democrat politics that are likely to be surprised by a new generation coming to the fore.
Okay. I'm hearing a lot of echoes of Neil Howe, sort of in what you're saying with his fourth turning. And I'm sort of fresh off interviewing Neil from like a week or week and a half ago. So what I hear you saying, Peter, is there's a lot of underutilized human potential, if you will, in the younger generations right now because they're sort of stuck in the passenger seat. But just as Neil would say, in a classic fourth turning, the pressures keep building as the status quo starts to fail, but they eventually become so intense that it's almost like the heat that then gets hot enough to create a chemical reaction, right? To break the bonds, let new molecules form. And that'll be transformational for these generations. And I get the sense, don't let me put words in your mouth, but that you're not saying these are lost generations, that's it. These are never going to be useful, uh, age cohorts. They're going to sort of have a great awakening at some point here. And that may then unlock a lot more human potential where they start getting out of the passenger seat and into the driver's seat.
Yeah, one of the things that, again, all of the media would lead you to believe that the issue today is uncertainty. I don't believe that. I believe the issue that is lingering is a sense of powerlessness. And what I know looking at social movements is that you can have all the uncertainty in the world, but it is the addition of powerlessness that creates the spark. So if we think about Occupy Wall Street, we think about Black Lives Matter, we think about the spontaneous events that take place. It's an issue of a demand to take control, even if it's wrong. That I
Mhm.
have to do something in response to what I'm feeling.
It's sorry to interrupt, but I'd love for you to riff on this. I mean, you're making me think of the American Revolution, where the colonists, they thought of themselves as British, but they just kept getting insult after insult, stamp acts and all sorts of other things that
Yeah.
just kept increasing to the point where they felt like we have no other choice but to do this. And we know that like if we do this and we lose, we're going to get steamrolled by the most powerful army in the world. But our backs are against the proverbial wall here where we now have to lean into this.
Yeah, and for the young, they have nothing to lose.
Right.
I mean, they look at I mean, you look at the wealth divide, which is something that as you know, I've been writing about for a long time. I get frustrated because the media would lead us to believe that the conflict is left or right. I believe the conflict is in terms of economic and wealth terms, up
Hmm.
and down. And what I see for those at the bottom is an immense weight of vulnerability. They feel powerless and uncertain in so many dimensions at once. And that weight ultimately creates a tipping point where they will do something. And I have no doubt that the extraordinary wealth divide that exists today is going to come to an end, because those at the bottom will not allow it to continue in place.
Okay, and so very curious, what is your thinking on how that is likely to manifest? I can make an argument it might manifest in a way where financial prices crater, and therefore the rich just aren't as rich relatively as they were. And a good example might be, lots of boomers are really hoping to sell their McMansions at current market values, but most, millennials who are the natural buyers can't afford them. And so the boomers just might be forced to have to take some big haircut on that. The other way I could make an argument for it is millennials get into political power and it's confiscatory taxes, right? How do you think it's more likely to play out?
So I think you can look at all of those. I think, too, we need to recognize that shareholder primacy is a relatively modern, recent phenomenon. And this notion that in all instances the shareholder comes first, I can see the shareholder sacrificed. That shareholders are an easy symbol for those without to go up against. Whether you label it Wall Street, the rich, the shareholder class feels particularly vulnerable to me. Um, I also think that you have this question of technological change that could just as easily upend where value is. And so I don't know what the trigger is, but I think we're naive to think that the status quo, where the system bails out the shareholder at every turn, is sustainable.
Okay, and if that's your thinking, how material is it that the new president is using language like Wall Street's headed good for a long time, we're now going to prioritize Main Street over Wall Street?
So I think our current administration has a very challenging tightrope to walk, because it was elected by populist support, but is also incredibly beholden to the ultra wealthy. I mean, you look at who attended the inauguration, um, you know, the number of billionaires in the room and the cabinet. So this is a precarious position for an administration. And what I see is sort of this to and fro. 1 minute it's like the sort of the biblical story, loves the first, hates the second, loves the second, hates the first. But you see this tension where you have deliberate appeal to one group and victimization of the other, and then you switch to the other side. And I think that that's a tough act to keep going, to try and placate those that have diametrically divergent preferences, interests, wants in the outcome.
So, that said, do you see this as a progression? Meaning, looking at previous recent administrations, seems like they were pretty much on team capital, if you will. And now this one seems to at least be giving some lip service to labor as well. Maybe it's trying to thread the needle, maybe it might not be able to. But is that the natural progression you need to get to before you start seeing policies that are enacted that really prefer labor over capital? And I'm not saying necessarily the Trump administration is going to be the one to do that, but is this sort of the progression you would see on the way towards Main Street taking over from Wall Street?
I guess I look at administrations following Main Street as opposed to leading Main Street.
Hmm.
And so I look for tension to mount on the populist front that suggests that the winds have changed. And in some ways, you could look at the sacrificing of Elon Musk as an example of where the administration has chosen to sacrifice, one of the elite in order to placate those at the bottom. We'll see how this plays out. And just to be aware, this is not a uniquely American phenomenon. I did a presentation recently on what I call a few good men. We live in a unique moment in history where we have country after country being led by dominant, independent nationalist figures.
Right.
You know, you've got Erdogan in Turkey and in El Salvador, in China, in Israel, in India, in Hungary,
Hungary,
Romania.
Argentina. You've
Yeah,
seen the rise of Le Pen and AFD in
yeah.
Germany, even. Yeah.
And so
Maloney.
what I think is going to be important to watch is how do these individuals sustain their national support or quell their national nonconforming in an environment where ultimately they are in competition with each other. One of the things you were talking about earlier was diversifying by company. I think that the big challenge for investors today isn't diversifying by company, it's diversifying by country,
Hmm.
because you have independent leaders who are going to dictate policies. And I think you as an investor have to conclude, in this country, do I believe I will be a beneficiary or a victim? And even more importantly, do I think others think they will be
Right.
beneficiaries or victims? And that's decision making that most investors today have never had to contemplate. That when they've talked about emerging markets or frontier markets, it's been the concept of opportunity. They sort of overlook history where you had nationalist leaders who were not always kind to capital from abroad. And I think today we need to think about this holistically, globally. Okay, you choose you don't want to be in America, but where are you going to go otherwise? What is an environment where your American money is going to be warmly received and you will be a beneficiary and not a victim in that other country?
That is such a great point. And I'd like to dig into it a little bit more, but let me ask first, because you put your finger, I think, on a massive sea change that is in process, right? Which is, up until a year ago, ish, globalization was the playbook, right? And that really has it's getting swiftly dismantled worldwide, as you've said, right? And who knows what's going to happen, but I find it hard to feel like we're going to go back to it anytime soon, if at all. And I've had people on this channel who have really studied this, geopolitical history, who for many, many years have been saying, look, globalization is the exception, not the rule here. And we're just the pendulum swinging back to the way the world has pretty much always worked. So you could say that confidence in globalization has suddenly gone through an accelerated erosion. Um, Beyond some of the implications for investors you've mentioned, just how important is that?
It's hugely important because to me it's a reflection of deteriorating confidence. I talk about us everywhere forever as the mindset at peaks in confidence. And the idea that you could get anything from anywhere to anywhere overnight. I think of FedEx as really the embodiment
Hmm.
on a corporate perspective of this mindset of globalization. And so what we're doing is turning inward, as we always do as confidence falls. And we're discovering the fragility of a highly complex, interconnected system,
Hmm.
as we always do. So there are what we're revealing isn't to me anything new. It's these are the same things we saw in the mortgage world as confidence deteriorated there.
Yep.
You know, and what's the implications then, I think, have to be looked at in a couple of dimensions. And these are critical elements if you're running a business. The mobility of labor, goods, capital, and information. And I look at those as four variations on a single theme of confidence. I know that when confidence is high, all of those will be mobile at once, intensely mobile and frictionlessly. I know when confidence falls, all of them will be subject to barriers, walls, moats, impediments. And this is where I think if you're looking at the markets, you need to be looking at immigration policy. You need to be looking at trade policy, because ultimately that becomes capital policy.
Hmm.
And so, what does it mean as countries are balkanizing and creating impediments to the mobility of individuals and goods? I think it's only inevitable before we see that in the mobility of capital.
Okay. Um, so let's see here. So, you know, I guess let me go narrow first, then we'll go maybe wider again. So the new administration has been extremely disruptive. I think in many ways it has surprised its own supporters at times, right? So, for example, the way that the Liberation Day tariffs were rolled out, I think even surprised a lot of people that were sort of on Team Republican. Um, and so you could make the argument that that is further evidence of what we're talking about, which is countries all of a sudden uh, breaking away from norms and what's expected to do something that they think is in their extreme, self-interests. But also that you could just say, look, so far the new administration is just eroding confidence because people either don't like the direction things are going in, or it's just additional uncertainty. And when you're more uncertain, you have less confidence, right? Um, so I'd love to get your thoughts on that, but if I can, while you're answering that, Trump has thrown up a lot of dust in the air. He, at this point, though, has a lot of accomplishments that he can point to now and say, I got that done. I got that done. We're getting making progress on this, right? So there is becoming more certainty, even on the crazy trade side. Even since Liberation Day, we've had, prices have still largely come down. We haven't seen crazy inflation yet, at least. We've done the deal with the UK, China, which nobody thought was going to come to the table, and they were saying they weren't going to come to the table. We're now doing talks with them. Um, Trump's trip to Saudi Arabia, has a trillions worth of announced deals and commitments and buying a bunch of Boeing planes and all sorts of things, chips commitments, all that type of stuff. So, there's a whole long list, and I've mentioned it in a couple preceding videos here, where you can say he's removing uncertainty now from things. And of course, the markets have made up for all of their April losses. The S&P is now green on the year. Um, so, how do you see Trump as of right now in the new administration? Is it more disruptive change agent that is eroding confidence, or is it more uh, breaking some of the things that needed breaking, and it's now actually building momentum in a way that may increase confidence?
I think, Adam, that all of those are true. And I think that for some, the idea that you can hold something that is scalding hot in one hand and icy cold in another feels like being disingenuous. But I think it speaks to this tightrope of trying to satisfy one group and another group who have diametrically opposed wants. And so what he can do today is to demonstrate that he has satisfied both of them. At the same time, I think it's also fair for others to say that they have been immense beneficiaries, and others to say that they have been immense victims of what has happened. Both of that's all true too. And so I think that the challenge for folks in trying to create a singular story that he's all bad or all good is almost self-defeating, because you have to recognize that what he's trying to do is to satisfy both ends of the spectrum at once, and will create very visible, highly touted successes for both groups, so that when he walks in the room with one group or the other, he has the ability that you've just identified, that he can talk about his successes. And that is his nature, that is his want, and he has been given the ability to do that. The question for him, and he's not alone in having this question, is can you continue to do that? Does the crowd on either end allow that to continue in an environment that feels like red light, green light, where it's all gas pedal, all brake, all gas pedal, all brake? And some would suggest that it begins to feel like an abusive relationship, where one day you've come home with flowers, the next day you've come home and hit somebody backside the head. And so that exists in plain sight. And so I say, yes, he has been successful in delivering to both. The question will be, can he continue to do this in a way that maintains a sense of certainty and control?
Okay. I think you just described a pretty complicated situation in a very effectively simple way. So thank you. That actually helped me. Um, so then let's trundle into the so what part of the discussion, Peter, which is, okay, so you've kind of, I think, really effectively described the situation that we see ourselves in, and some of the things that investors need to care about more now than they didn't have to, up until now, pretty much. But for the lived experience of the average person and average investor going forward, what do you think is more probable? I kind of get the sense from what you've said so far is that things are going to continue to be volatile and rocky, and before we get to the optimistic part where the younger generations find their sense of purpose and we unlock all that potential, pressure is going to have to get greater, meaning pain is going to have to mount. And so it's probably not going to be a super fun journey in the short to midterm before some of those really transformative actions happen. So I don't want to put words in your mouth, but like, what should people kind of be mentally preparing for from here?
So I think investors need to be thinking about, are the companies and the locations that you are investing in, will they be beneficiaries or victims of the dominant national leaders where they're operating? And here I think it's going to be increasingly challenging for these trans global companies to satisfy not just two masters, but 12 masters at
Right.
once, each with competing demands. And again, their challenge is trying to placate individuals who have absolutely opposing goals and objectives. And so they too are now on a tightrope. As investors, you need to be thinking about things in terms of not gains or losses, but beneficiary or victim. That in every case, what I see is a binary outcome. You see folks winning in an extraordinarily enormous way one day, and others who are being brutalized the next. And we see this in price changes and just global sentiment. And I think you have to think about, if I'm owning a stock, what is the probability that my CEO ends up having a Zelensky moment in the White House? Because I think that in the not too distant future, we will see a CEO, just face a very confrontational president who wants to make clear that compliance is required.
Mm-hmm.
And again, these are he is not alone in that. I don't want anybody to think that I'm trying to single out, President Trump, good or bad. I just see him as one of many representative figures today.
Yeah, and that's consistent with Michael Every, who is one of the analysts who, for a long time, has been predicting this return to nationalism or mercantilism. And
I think of it almost as feudalism.
yeah,
These are feudal leaders.
so Michael has again was promoting this before it became as obvious as it's becoming now. But one of his things that he mentions, he says, look, in a mercantilist society, you could even say feudal society, but in a mercantilist society, the government is really, instead of just letting sort of free trade flourish, it is saying, look, we've got national priorities, some of them that might trump economic priorities. So in some cases, the economy is going to be subservient to a greater national priority. And to guide ourselves towards those national priorities, we may feed this part of the economy while intentionally starving, or we may intentionally starve this part of the economy to feed this part of the economy, right? And then that might shift next year as our strategic priorities change, right? So you kind of have to be willing to keep your eyes open for that. And that very similar to what you're talking about, like a Zelensky moment, you might get a kind of like what China did with Jack Ma.
Yeah.
You could see something happening here where Trump says, look, we're really trying to get, X manufacturing back up and running in the States here, and a big CEO that's standing in the way of that. Trump might say, hey, you know what? Just like he did to Harvard, right? Okay, well, we're going to revoke we're going to stop giving you grants. We're going to revoke your tax exempt status. If you're not playing ball with us, in key sector X, there might be some bad things that happen to your particular company. Your competitors who are playing ball with us might be just fine, but we may starve you out.
Yeah, I think people bristle when I talk about centrally planned government and economy, but this is going to be centrally dictated, so long as you have a independent nationalist leader. And this is where I talk about shareholder primacy. I believe is a myth today. That shareholder primacy is incompatible with the kind of political agendas that I see around the globe.
All right, so that's really super interesting. Does that in any way then make you feel a little more like, okay, then stay invested in the markets. You're not telling people get out of the stock market entirely, but you're giving them more dimensions that they've got to pay attention to. But does it also make you kind of think like, and therefore you might want to hold some of your wealth in assets that are less susceptible to this? So gold might be an example, right? It's a physical form of wealth that you can hold, and unless the government tracks you down and tries to forcibly take it from you, it's yours, right? Or real estate or other types of assets as well. But I'm just curious, does it inform your thinking that way at all in terms of assets to own in a full portfolio?
Yeah, it makes me think about geographic diversification.
Mm-hmm.
It makes me think about assets that have utility value as opposed to investment value, because I know that as confidence falls, utility matters more than potential return. And so as our time horizons shrink, what matters changes. It's, ramen noodles are currency in most jails today.
Mhm.
So you need to be thinking about what has utility value, what will ongoing have utility value, and do you own that? Um, and I think that as you are evaluating your investments, if you're going to be a shareholder today, you have to filter them through political risk screens first. That political risk, rather than being the fourth or fifth element of an investment decision, is now the first element. How will this fare with Mr. Modi? How would this fare with Mr. Erdogan? How would this fare with Mr. Trump? Because
Y-
those those individuals are going to determine your fate.
It's so interesting. You're making me realize you're connecting a dot here for me. I have found myself talking about politics way more in the past 4 to 6 months than I had in the past several years, on this channel. And um, it's not because I've wanted to. It's not like that was an intent or a priority. I'm just finding it's becoming increasingly hard to try to forecast where things are going in the economy without taking these political policy decisions into consideration. And so while I had this cognitive dissonance about like, why am I doing this if it's not really what I'm setting out to do? You're connecting the dot with me, which is because I have to do it. It's just we're entering a period where you have to take in the political winds much more than we've had to in the past.
Yeah, and I would say to those who are ardent Trump supporters, appreciate that he will make decisions where you will be both a beneficiary and a victim.
Hmm.
And I would say those who are Trump, opposing, there will be investments that are beneficiaries and victims. And to paint these dominant leaders as all good or all bad, as the media would like us to do, really distorts how people take risk today. You can see it where, if I talk to investment advisors, they joke about their red client portfolios and their blue client portfolios. It's like that's not a healthy approach, because as we've seen, these dominant figures are often mercurial. And so you have to be prepared for their mood swings.
Oh, that's really super useful. All right, well, Peter, look, is there anything kind of on the confidence spectrum that you look at closely that I haven't thought to ask you about yet that's worth putting on the radars of our viewers here?
Yeah, I think that investors today need to anticipate bungee jump like movements, because what I see is decision making that's no longer driven by value, but is driven by price. That it is the movement in price that is soliciting enormous entry or enormous exit.
Okay.
Folks are not being reflective. Very few folks today are taking the time to think about value and what's something worth. And I say that because I think investors need to appreciate that currencies themselves are where a lot of value gets hidden, get exposed, gets created, and gets destroyed. And so if we see, lots of discussion around the dollar collapsing in value,
Yeah.
well, you could see the S&P skyrocket in nominal terms in that. But the price and value will have become completely decoupled.
Hmm.
And I just encourage investors to step back sometimes to think about things in terms of value, you know, earnings multiples, cash flows, things that ultimately drive the success or failure of a company. The other last thing I'd leave you with, Adam, is to appreciate that in the world of currencies, it's a game of relative beauty. And so when I hear people saying the dollar is going to collapse, it's like, well, that would suggest then that the euro will rise in value, the yen, the yen, all these other currencies will appreciate in value. And that may or may not be the case. What the currency market helps us to see is what are the best and worst houses in a bad neighborhood today. And so I encourage folks to pay attention to the currency market because they're really giving us a read of how does global sentiment feel about one country versus another.
Versus another. Yeah. All right. Well, look, how does history tell us? So if people are not investing based off of value, and I agree, they haven't in large part, painting with a broad brush here, but they haven't in large part for a good long while. If you look at how elevated valuation metrics have become, really over the past decade plus, but at the start of this year, we were, well, things cooled off a little. Now they've heated back up, but I mean, we had almost every valuation metric that you could point at, we were either near all-time extremes or at the all-time extreme, right? And there's a meme that's been circulating over the past year or so on social media saying, this is the single best investment decision you can make. And it's a picture of somebody tossing Benjamin Graham's Intelligent Investor into the trash, right? Kind of meaning like the old rules don't apply anymore,
Yeah.
right? So what does history tell us when we fly the market plane, not by valuation metrics, but by price metrics? I mean, I'm assuming they don't end up well, but you correct me if I'm wrong.
They don't end up well. And ultimately, what markets bottom on is immediate tangible utility value.
Mm-hmm.
So the time horizon is today. The hypotheticality of it all is very small. It's, is this useful or not? Is it useful to me here right now? And so I encourage folks to think about having in their portfolios things that would have immense utility value in a crisis. We watched with COVID as people were racing to Costco to to with their pallets of different
By the
things.
base fundamentals, my toilet paper, yeah,
Yeah,
like bags of rice,
yeah,
yeah.
and what that was telling to me is, oh, these are the things that have immediate tangible utility value.
Yeah.
And I'm not saying, fill your house with toilet paper. What I'm saying is that if you're going to invest through a crisis successfully, those companies that provide those goods are much better standing and a much more stable foundation than, some sort of meme coin.
Okay. So, I mean, to my mind, this is sort of things like consumer staples. It's probably even like utilities, it's commodities or commodity producers, just essentials that the world needs, not quite so much the high flying growth stocks or consumer discretionary or things like that. Am I thinking about this the right way?
Yeah, needs not wants.
Okay. All right. Well, Peter, look, I'm looking at the time. We're up here at the hour. I could go an awful lot longer for you if we had the opportunity, but I've got to be respectful of your time. It's always super fascinating to talk to you. I'm going to ask in just a second where people can follow you and your work, but I do just want to re-mention from my discussion with Jesse, your book, The Confidence Map. When Jesse was recommending it, it was prominently right there on the bookshelf behind him. It's actually over your shoulder right there. Yep. So where can
Shameless.
people who are really interested in your whole construct of looking at the world through the lens of confidence, where can they buy your book? Anywhere books are sold?
Anywhere books are sold, Amazon, Barnes and Noble. Support your local independent bookstore, please. Um, yeah, and I think what what gives me the greatest satisfaction with my book is that people read it particularly investors, thinking it's a book on economics or investing in confidence. And then they'll talk about with me the life experiences that it's helped them to better understand. I had a hedge fund manager who, his eyes welled up as he was talking about his wife's experience with cancer and how
Hmm.
the framework, powerlessness and uncertainty helped him to better organize the journey that they had been on. So it's a book on decision making that uses economic and investment examples, but it's to me it's all about decision making.
Well, that is great and obviously well deserved from all the work you put into the book. In some ways, I mean, I find the field of behavioral economics so fascinating for a whole variety of reasons. One, because we think economics should be so easy to understand because it's so quantifiable, and then the human equation just makes it all totally irrational in many ways. So we need these frameworks to think it through. But I also I put it in the same category as Robert Cialdini's influence, which you're nodding vigorously here. Um, it's you read it and then it really does change the way in which you look at the world. You can see the world differently, and in many ways, you're better armed to deal with what the world throws your way because you actually now have a framework to understand it and react to it. So, anyways, great work on that book. For folks who can who would like to follow you and your work in between now and the next time you come on this program, Peter, where should they go?
So they can find me on X, on Blue Sky, on LinkedIn. I write in different voices for those different environments. I also write commentary through Financial Insights, which is my consulting firm, where I try and use the framework that I write about in real time, you know, where sentiment matters in the markets.
All right, fantastic. And Peter, when I edit this, I will put up the links to your handles there and your website on the screen so folks know where to go. Folks, those links will be in the description below this video as well. All right, well, look, Peter, hang on just 1 second. I want to do just 30 seconds of housekeeping, and then I want to give you the last word. Folks, if you've enjoyed having Peter on this interview, even half as much as I have, please let him know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you would like to get some professional help in navigating this future ahead, which I think is fair to say Peter thinks is going to be fairly volatile for a good while, and maybe have some increased pain ahead of it before we start climbing into some better future, then highly recommend that you leverage the expertise of a good professional financial advisor. Importantly, one that understands and takes into account the issues that Peter has discussed for us here. If you've got a good one who meets those criteria, great, stick with them. But if you don't, or you just like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the short form at thoughtfulmoney.com. Only takes a couple seconds to fill out the form. These consultations are totally free. You get personalized, bespoke advice from these advisors after they've sat down with you and learned about your specific personal situation. And there's no commitment to work with them. It's just a public service they offer to be as helpful as they can. All right, Peter, thanks for your patience. So the folks watching this video, in large part, yes, we do have some professional investors, but most of them are just regular people who have been working hard to build some wealth to provide for their family's financial future. And I'm guessing many of them feel a little discomfited by the increase in uncertainty and volatility of this year. Um, what would your advice be to them, for the ones that I think their core fear is just things are getting so uncertain that I'm afraid the odds are getting higher that I'm just going to become collateral damage to these forces, and my wealth's not going to make it to the other side when I need it.
So one of the things, because of all of the volatility that I say a lot these days, is that it is important to plan for what you can imagine and be prepared for what you can't. It troubles me to see investors who are all in or all out. And that leaves them exposed to what they can't imagine happening. And I think this is an environment where tempering the want to be risk in or risk out is really important. The future is inherently unknown. And what changes isn't the future, it's us and our feelings. And when we feel things are uncertain, that's really on us. And that's a statement of our level of confidence. And so I encourage individuals to listen to your stories because they are a function of your level of confidence. And we need to be careful not to get seduced by them because they will be most seductive, most, absolutely affirming at extremes in confidence. And that is where we ultimately make our worst decisions, good and bad.
I just want to underscore what you're saying, twofold. One, you are right, and I talk with many, experienced financial advisors on this channel about how, as investors, it is most frequently our own emotions that are our biggest enemy towards our investing success. That when we make emotionally based decisions, they tend more likely to be the wrong choice at the wrong time, right? So A, that, but B, hearing this from you, Peter, who is, one of the most widely respected behavioral economists out there, is it's not just an opinion that you're slinging. This is your life's work in studying how human emotion impacts investing decisions. And just one thing you said, it's going to be when you feel most certain something's going to happen, is when you probably need to apply the greatest discount factor to that certainty.
Yeah, and I find myself plotting my own mood on the map, and that helps me to realize, okay, you're looking for trouble here.
Yeah.
And just
And just to make it actionable for folks, it doesn't mean, oh, I feel really certain about this, so therefore I should do the opposite. But it just means that don't go 100% all in, right? At least have some hedges in place, right? Okay, in case my plan A doesn't pan out, let's make sure I don't get totally destroyed and I've got some chips over here on a plan B. Or it's do plan A 100%, but only at 80%, right? Keep 20% of the portfolio away, right? So you're nodding as I'm saying all this, right?
yeah, I I'm a big believer in confidence diversification, that's ultimately what saves you as an investor. You should have in your portfolio something that is great, feels good, is doing really well, and then you should have something that would make others laugh. That you hold this thing that if you went on Twitter and said, I own this, the crowd would ridicule you because ultimately it is owning a mix of emotions that creates portfolio diversification. You don't ever want a pie that is all hot or all cold. I want pieces that are piping hot and are right out of the freezer cold because I know
So
that that's going to help me over time.
I totally understand the logic behind that, but I want to understand it a little bit better in the sense that you want to truly diversify, and I like this concept of using levels of confidence as a way to diversify. I'm real certain about this. This one I'm not that certain about, but I'm going to have some exposure to it anyways, right? But I don't necessarily get the sense you're saying, okay, put some chips on the thing you're most confident in, and then try to find the dumbest investment that you could find, right? So, for example, I don't, unless you want them to, I don't want them to take away, okay, let's say you're really into, the Mag 7. So you're going to go big Mag 7. But then you're going to go buy some fart coin just because it sounds like the dumbest thing you could think of.
No, I think it's more tempering your portfolio. Yeah, I mean, what the last several years have shown people is if you have a pie that is nothing but Mag 7, that pie has done extraordinarily well. But when that pie cools, the entire pie is going to cool.
Right.
And so I like to have things that are abstract because they'll do well when confidence rises. I like things that are tangible as well because I know they will do well when confidence falls.
Okay. I think that's a very helpful clarification, and I really I think, interesting and probably, quite successful way to look at how to diversify. Peter, thank you so much. This has just been wonderful. Best of luck in the interim. I'll continue looking at your work. Highly recommend folks go read your book. And I'll invite you back on in about a quarter or so, unless something happens in between that really materially changes your read of the confidence map. And if that does happen, I just want to make sure you understand the door is always open for you here at any time to come on and let us know, call an audible midstream if you see a big change like that.
I appreciate that, Adam. Thank you.
All right. So wonderful, Peter. Thank you. And everybody else, thanks so much for watching.
China is buying gold like crazy. The people in China are buying gold. They love gold, and the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system, and they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin
Of
predominant.
course, no, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yeah.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries, the society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air. And on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months. Updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather in a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go, basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative, long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those 4 drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those 4 drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past 5 decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train, it just pushes higher. And whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember.
Yeah.
I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
Russia, China, and now India. Um, you know, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system.
The trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by. I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond.
Central banks, especially in India, Russia, China, and other global South nations, are boosting gold reserves while cutting U.S. treasuries, marking the first time since 1996 that gold has surpassed treasuries. India alone has reduced its T-bill holdings to $227 billion, while raising gold reserves to about 880 tons. Meanwhile, Eric Jung predicts that with gold hitting record highs above $3,500 to $3,600 per ounce, forecasts project $3,700 to $4,000 by mid-2026 and potentially $5,000 plus if Fed independence is challenged and a wider shift from treasuries accelerates. So the U.S. can revalue its treasury gold reserves at much greater market levels. Eric Jung is a financial commentator and analyst who frequently discusses gold, silver, and macroeconomic trends. He highlights that gold consolidated for months before breaking above $3,500, while silver pushed past $40. Many dismiss the idea that Trump's tariff threats explain this move, since that narrative has been recycled for months. What really drove the breakout was the recent BRICS meeting and India's shift, reducing U.S. Treasury holdings while increasing physical gold and silver. Combined with America's ballooning $37 trillion debt and talk of confiscating frozen Russian assets, these pressures pushed India further toward hard assets and away from treasuries. This reflects a much larger global trend. Countries like Russia, China, and now India are abandoning U.S. treasuries and adopting physical gold as a reserve asset, signaling a fundamental change in the financial order. Unlike treasuries, which can be frozen or seized by Washington, physical gold held at home cannot be cancelled by a foreign government. Eric believes as a result, sovereign demand for gold is accelerating. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
Gold, I think, consolidated for around 5 to 6 months, and it broke out of $3,500, so $3,500 US dollars per troy ounce, and silver went beyond $40. I think that was the top it made a couple months ago, several months ago. So it's now above $40 US dollars per troy ounce. And I know the mainstream narrative of all this is that the tariffs, the Donald Trump tariffs, potential tariffs on gold and silver is not clarified, but I don't buy that because they've been using that narrative for over 6 months. I mean, how stupid do they think the authorized participants are? Bankers are, right? This is ridiculous. I think what really happened is BRICS happened, like that BRICS meeting that just happened, and what happened in India. I don't know if you know, Danny, but the Indian central bank is now reducing their U.S. Treasury bonds and T-bills holdings and increasing gold, physical gold, and guess what? Also silver, physical silver holdings. Okay, that's why I think, in my opinion, that's why gold and silver broke out of the trading ranges. Donald Trump, but it's funny that it just seems that nothing that India does pleases Donald Trump. And Donald Trump came back with a 100% or more tariff on India. So I don't know. I think it's as simple as that. It's just like somebody is trying to be nice to Donald Trump, and Donald Trump instead slapped additional tariffs on that country, and therefore that country is pushed over the edge. And now, they are reducing officially their U.S. Treasury bond holdings. But I think the underlying reason, Danny, is we've said this before. Two things. Number one, look at the U.S. national debt, $37 trillion and counting. $1 trillion of additional debt every 3 to 4 months. Okay, so this ain't gonna stop. Number two, recently the EU is supposedly potentially going to be pushing the button to confiscate the frozen Russian assets. Okay, that they froze, when Russia started that special military operation in Ukraine. So I think combining all these different, factors just really gave India the extra push to push that button to let go of the U.S. Treasury bonds and T-bills and dive in officially into gold and silver. Then recently, gold just shot up and exceeded U.S. Treasuries. So I know a lot of people make fun of this, but what that tells me is that led by the global South, Russia, China, and now India, you know, uh, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system. Because going forward, I don't see there's any, significant steps of this trend in reversing. Simply because in a multipolar world, physical gold is not controlled by any individual country. Nobody can just push a button and cancel the physical gold that, let's say, India, China, and Russia hold at their, domestic vaults. Okay? But, let's say if you hold a lot of US treasuries and you piss off Uncle Sam, somebody like, I guess Bessons or Jerome Powell, whoever, can go back to the office, push a button, and buy. Your stuff is frozen, or worse yet, it's going to be confiscated, or deleted, or whatever, right? So I think, like I said, I think flight to physical gold at a sovereign level is not going to stop. It's simply going to accelerate. And physical gold, like Francis was saying, is just at its beginning phase of being remonetized. And it's going to accelerate going forward.
Francis Hunt, known as the market sniper, along with Eric Jung, points out that central banks remain steady net buyers of gold, with India notably reducing U.S. Treasury exposure while increasing its gold reserves over the past year. Analysts warn that even modest reallocations from treasuries into gold, potentially in the hundreds of billions, could drive prices sharply higher, given tight liquidity and the outsized impact of institutional flows. Forecasts suggest gold could reach $3,700 by end 2025, around $4,000 by mid-2026 in base cases, and near $5,000 in stress scenarios, expanding its market cap from roughly $24 trillion to over $31 trillion. This shift is driven by geopolitical tensions, rising U.S. debt, and concerns over dollar-based assets being frozen or seized, making gold the preferred non-sovereign reserve asset as nations diversify away from treasuries. Let's just get back to the interview.
What percentage of that is losses in treasuries as well and gains in gold, which further eggs the point rather than saying that there's no one selling. But people don't like to accumulate an asset that is losing value, and they double down and accumulate assets that for the extended future they see as accumulating value. No one gets fired for buying gold or for hiring McKinsey, they used to say. I don't think central bankers, and it also puts something else. I'll throw two other thoughts in on that chart, which I love, and I'm glad you shared it. I saw it as well. There's no chart for it, but I can tell you those nations that are accumulating and also seeing appreciation in their gold whilst not adding to their treasuries and watching devaluation, they're also not choosing Bitcoin. They're choosing gold. They're choosing gold predominantly here. And that tells me there's a very Americanized probable stigma in terms of the potential creation, because there's been no embracement by institutional central banks in the Deep South or the Grand South or the Global South and the BRICS nations. In terms of Bitcoin on a meaningful basis. They accumulate it where they have a criminal who's trading in stolen cars or something, right, fine, and they hold it. But there's not a net accumulation on that side as well. So I think when you look at the big money that knows, the big money has spoken and the winner is gold. And the appreciation will be far more safe in a less volatile way, and you won't have to watch an 80% cycle deval or 75% one if you miss the perfect selling point either. And people need to remember those key aspects about Bitcoin and gold, and why I think gold is the winner. It's the safe hands for everyone. Yeah, in terms of the market cap as well, again, but don't forget $1,500 extra on the gold ounces. That's actually in percentage terms from 3.5. It's almost like another 50%. It's probably around 35 to 40%. So you would go from 24 trillion plus another third. You'd add another 8 trillion on that, and you'd be at 31 trillion. So I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond 50 and beyond. Eventually, my feeling is that whatever the debt market was at its high point, the amount of money we felt existed at its biggest bubble of the debt market, we end up seeing that deflate, and by however much that deflates, gold goes up, because there's really only one trade for me. What do? You don't buy real estate that's already leveraged with debt at ridiculously high prices. You don't chase a hyper overvalued record PE stock market. Some people will, and there will be elements. But when this is fully played out, the natural approximate geometry is however big the trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by.
The accelerating move by central banks, especially in India, Russia, China, and other global South nations, away from U.S. Treasuries and into physical gold signals a historic reshaping of the global reserve system. With gold breaking record highs and forecasts pointing toward $4,000 to $5,000 in the coming years, the metal is regaining its role as a core anchor of financial security, driven by sovereign demand, geopolitical uncertainty, and distrust of dollar-based assets. Could a mass revaluation of U.S. Treasury gold reserves at higher market prices fundamentally reset the global financial system? How might continued BRICS diversification into gold and silver impact the long-term dominance of the U.S. dollar? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
Based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point.
Analysts project a rally into the $3,700 to $4,100 range, representing a move of over 20% from current levels, similar to the breakouts seen in 2007. Goldman Sachs maintains a base target of $3,700 by year-end and $4,000 by mid-2026, while noting that in extreme scenarios, prices could rise to as high as $4,500 by year-end 2025. Momentum is strong, sentiment is bullish, and key catalysts, such as rate shifts, geopolitics, and safe haven demand, are aligning for a potential breakout ahead. Chris, founder and CIO of thetechnicaltraders.com, recalls that back in 2007, gold was expected to rise by about 20%, but instead it rallied 37% as equities peaked and began to decline. Today, analysts observe a similar setup, with gold forming a classic bull flag pattern and Fibonacci targets projecting gains between $3,722 and $4,100. If momentum builds and the trade becomes crowded, some forecasts suggest gold could even overshoot toward $4,500. Should equities weaken, history indicates gold could surge even more strongly, with silver and mining stocks likely to follow. Traders are watching closely for technical confirmation, particularly a breakout to new highs in ETFs like GLD. Meanwhile, physical gold buyers are steadily accumulating, seeing it as insurance before a significant breakout. Once gold truly takes off, physical supply could become scarce as investors with access keep it locked away. That's why many prefer to stack and store gold now before a potential perfect storm drives demand through the roof and makes it nearly impossible to acquire at any reasonable price. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
This type of scenario, gold actually had an upside move, a measured move in 2007, just as the stock market was putting in a significant top, which I think is close to where we're at right now. Gold should have rallied 20%. Not only did it rally 20%, but it blew past it and went up 37%. And so right now we have a very similar chart pattern. Gold, if we flip back to the chart of gold, has this, I love to use Fibonacci extension, Fibonacci theory. If you don't know it, you have to look into it because it's in everything in the universe. But more or less, it tells us where the upside targets are. Now, based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily. And we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside. And if you compare what happened in 2007, if we were to just scroll forward,
Right.
we saw the stock market fall 20% and we saw gold shoot up 37%. And I believe we could see something similar. If we were to fast forward this, we would see, the stock market potentially top out and start to sell off, and gold just keeps going higher and takes off. So that's an opportunity. This is a very rare type of setup that's unfolding. And I think one of the key things for, short-term traders is if we look at the price of gold futures here, and I think this is very important for people to understand, is gold did break to some new all-time highs on the futures market, but that's not what I follow when it comes to trading gold for a trade. I like to look at any gold, physical gold ETF, GLD or whatever. If we zoom in on the chart price action, you can see we never did hit new all-time highs back when futures did. So I'm really looking for gold to break above, when GLD closes above 1750 more or less, I'll be like, okay, you know what? This is it. This bull flag is breaking out, and probably we got chaos in the stock market. This will be kind of the play for gold. So gold has got huge upside potential, and I think it'll bleed over to silver and miners as well. I think the people who take physical gold are extremely savvy. They have a ton of cash because they're buying it. I think it's very smart to be loading up on physical gold because there's gonna, I think, eventually be a time, Daniela, when gold is shooting through the roof. Nobody can get their hands on physical gold. It'll be like impossible to get because anybody who has access to it is just buying it up. It's not even getting out to the public. I think getting your hands on it before, obviously, it rallies and potentially we're in a perfect storm for gold and silver to explode to the upside. I think getting your hands on it is important. That's what I do. I collect physical gold. I just store it. I keep stacking it. I think I don't really do gold for a trade. This
Right.
gold trade I just mentioned to you is like, I'll jump into an ETF. I'll play that move as a trade, but I do accumulate physical gold. I keep it stored away and I want to have it in hand. So people accumulating the physical, taking massive delivery, I think they're just really savvy investors saying, hey, if this does take off, they want to make sure they have it because a lot of people will want to buy it. And there's a lot of ways to buy gold and you actually don't really own it. There's a lot of different ways that it's done, that you might not actually be able to get it if you really did want it. And the whole world is all fighting for it.
Silver continues to shine, but with volatility, as the iShares Silver Trust ETF is up about 33% year-to-date in 2025, drawing attention from options traders who are capitalizing on elevated implied volatility. Silver remains more volatile than gold due to its smaller market size and dual roles as both an industrial metal and a precious metal. In the near term, analysts and institutions forecast silver to reach the $40 to $50 range, with the potential for $46 to $47 by mid-2026, supported by technical strength and growing industrial demand, particularly in the renewable energy and technology sectors. Meanwhile, the gold-to-silver ratio remains unusually high, suggesting that silver is still undervalued relative to gold. If this ratio reverts toward historical norms, silver could benefit substantially from mean reversion. Gold, on the other hand, is viewed as the global barometer of risk, signaling when something in the financial system is breaking down. Its current pattern suggests a major breakout ahead, with investors moving away from stocks and real estate toward gold. This shift is seen as a warning sign that uncertainty is rising and markets may be approaching a turning point. In essence, gold is flashing caution, while silver offers explosive but unpredictable opportunities. Let's redirect our attention towards the interview now.
So silver is wild. It has a very ugly chart. It has a lot of noise, huge pops and drops, big rallies, big sell-offs. It's definitely more volatile. And I think that has to do with silver is a lot more of a speculative play. It's a smaller market, so it moves faster. Gold I like because it's kind of the global barometer. It's the whole world gets nervous. When gold moves up, it means globally there's weakness and people around the world are seeing something bad happening on the horizon. And that's what the big chart of gold is pointing to, is we're on the tip of something hitting the news, something that's going to change everything. I think that's what gold is warning us. But silver does have upside potential. I mean, it's in an uptrend. I think it could rally to short-term wise. The next upside target short-term is about $40.75. Not that high from where it is. But as you know, silver, when it does take off, it kind of just shoots and goes ballistic. If we were to zoom way out on the chart, it can have these massive explosive moves. And that's, it's really tough to gauge. Silver moves very quickly. If you blink, you can miss it. You kind of have to be sometimes just positioned in it and stomach the volatility. And then if that hits, then you're a part of it. But a lot of times some of these moves happen in 1 or 2 days, some of these big pops and drops. But when we look back on this chart, there is potential, though. We see gold shoot higher and silver could go up and tag that, all-time high of $50. It could spike up to that level. It would probably do similar to what we saw back in 2007. We saw silver. Let's just zoom in on that price action. In 2007, we saw, just as the stock market really started to sell off, we saw silver shoot higher. Percentage-wise, on average, it moved up about 20% or so. And interestingly enough, the chart pattern for gold and silver right now, Daniela, is gold actually has more upside potential. It's the opposite of what you think. It's the opposite of what everyone else thinks. They naturally go to silver for the bigger gains. But for some reason, all of my chart patterns for silver, and even when you compare what happened kind of back over here, it has the same or less potential for some reason based on technical analysis than gold. So I like gold because it's stable and I think it's going to be a big move. But we'll just have to see how this unfolds. Obviously, silver, if we were to go back, silver did have a pretty massive run from these lows. It was roughly the same, about 40% or more from like what gold did. Gold did about 37 as it broke and shot higher. Silver also did about 37 somewhat from the same time frame. So you kind of pick your poison, spread your money between both if you wanted to, right? Exactly. I think gold to me is the ultimate tool of uncertainty, and it looks like it's about to pop and blow up to the upside. And I think we're on the cusp. I mean, a lot of people, I've been expecting a big market correction to come at any point. I'm not jumping in front of it and betting on a huge correction in the economy and the stock market. If it wants to keep going up, I'll follow the trends higher. But gold is just screaming. It's like something is about to break. Something is wrong. People are moving away from real estate. They're moving away from the stock market. They're going into gold. And it's just telling us, just be cautious, right? It's kind of that warning sign.
Gold is indicating systemic stress, while silver is presenting high volatility upside, and both metals are setting up for potentially significant rises. The undervaluation of silver and its industrial demand could result in disproportionate gains, even if gold is the better long-term insurance against financial turmoil. When taken as a whole, they show that investors are becoming increasingly concerned about the state of the economy and the potential move away from traditional assets. Could gold's rise surpass current forecasts if there is a significant decline in stocks? Will silver ultimately beat gold in the upcoming bull market era if the gold-to-silver ratio returns to normal? Post your ideas in the space provided for comments below. Please support and enable notifications if this video is helpful so that you can stay up to date with our latest videos. I'll see you in the upcoming video. Thank you for viewing.